Hi, everybody. This is Gary Dean with Sentiment Timing, and this is our technical video report for Wednesday, January 17th, 2024. I'm not sure if you guys can kind of see a pattern that's going on here, but besides this really one-day massive rally that we had, or was it, 11, pretty much it was a day and a half, let's say that. It's been pretty much all selling the entire 2024, but yet we're not really that far off of where the highs are. But the pattern that I'm talking about, that it could cause some issues for the bulls in the coming weeks, is they're buying the dip. Well, what's happening is they're buying at the end of the day. That's where we're down 20. We closed down 26 today, but we are down 50 at the lows, and then it's like almost at the same exact time at 1:30 they start to bid it up, and then we end up only down 26. But this is what I'm talking about. So this was the gap down on the 12th. They moved it up and they closed it. This is where they bid it up towards the end and closed it right around the 47.83. Really wasn't that bad overall. But then we gapped down again. They bid it back up again, and then from there we're back down. And then at the end of the day, here's your buying spree that comes in. Gap down again. So we're seeing the same thing over and over, but the problem with that is all these people that are buying at the end of the day, they're ending up, depending on their time frame, that's probably the best way to look at this. But they're, all the dip buyers, let's just say they're short terms, they're underwater on all these. So if we continue this and then one of them we don't get an actual, bid back up towards the day, that's where, you could start to see some panic coming in. But the bounce made sense here because if we look, we had some bullish divergences in place. And this was the zone, if you remember what I put in the morning notes, that the bears needed to get through the 47.39 down to the 47.30, and if they did, we had this last level of support right around that 47.20. We broke that. That was the little head fake down, and then they kind of squeezed people out. But right now, this is some resistance right here, because you can see that we have the 50-day moving average as well as price resistance right at the 47.43. So not that far behind. So we should know what is going to be playing out pretty early, because if the bulls can gap it above it, the next resistance that we're looking at is not really that far above, where we can just say, let's just look at the close right here on it and say this gap right here, it's at 37.55. So there is resistance in these areas. And then remember, I've been showing you this is that bear flag. So we broke through it. And if you look at where this resistance is, we have the gap right here. You have the 200-day moving average. And then you also have the bottom of this bear flag. So this is obviously the important area that the bears need to hold back. If they don't, obviously there's some resistance at 47.67, and then it jumps all the way up to the 47.82. So this is pretty important. The next level of importance, obviously, is going to be right here. I think if the bulls can push above this, then it's just going to be another just quick move down, and we're back up again. But the fact that we're seeing these gap downs each day is, the market's always trying to tell us something. And I'm starting to see some, excuse me, some people starting to doubt that the Fed's even going to cut rates in March. And if you remember, like this entire, we had a decent run going off of the lows on the in October, which we were looking for those lows. And then this is pretty much where the Fed let loose everything and said that, they're looking to start cutting rates. But the street is marking in 6 rate cuts when, when Powell said he's only looking to do 3. But they're pricing it in like it's, like they are doing 6. And now there's people starting to doubt that they're even going to cut in March. So This is the Fed euphoria that I said the market has to move away from this. It's not sustainable because the Fed's not going to go back to the QE. They're still underwater on a lot of that. They've learned their lesson. They thought they were going to be able to pull the rug over everybody's eyes for as long as they wanted, and it was a combination of two things that really sparked this inflation. One was them shutting our economy down for a year, and two, pumping in another $3 trillion into the system. It's only going to start causing inflation, and the Fed was not really expecting all that. So I don't believe that they're going back to that. I think that the way that this market it moves sustainably higher is when the Fed is out of the question. They're not in it anymore, and it's not a matter of, oh, is there more money coming into the system? There's money out there that could be put to work from people, but it's right now it's the institutions that are taking the free Fed money or the whatever it is on that part, and just putting it into either buying stock back if you're a corporation, or leveraging the money that they're, the free money that they were able to get and put it into the market. That's not sustainable anymore. They tried it, it failed. And right now, everybody that's banking on the Fed going back to that, I mean, we're going to have to be in a depression for them to go back to those types of things. And again, where do you think the stock market will be if we're in a depression? It's not going to be at these levels. And that's really the one disconnect that I've been saying from the beginning, that the street is asking for lower interest rates so they can borrow at a better price and put it into the market. But really, the only way the Fed is going to start lowering rates drastically is if we're in a recession. So then you have the valuation that's going to go to the S&P and the Dow on where it is compared to what we're doing with GDP and what's going on with earnings, which in a recession, earnings aren't going to be good. So I'm like I said, I was scratching my head on the entire move up on that, where everybody's banking in all these rate cuts, but if anybody, and trust me, man, there's a lot of people that are a whole lot smarter than me. I don't know if they were just trying to get everybody convinced on it, but they know this. This is economics 101. That the Fed lowers rates when when the economy is going down, and they didn't raise rates when the economy started spiking up, and that's this disconnect with them, where they're not going to make that mistake again, and they're not going to just hang on to what Wall Street wants. So I mean, something's going to change, but these gap downs that are pretty decent sized gap downs too, like 25 points. They're telling us something right now. And again, I don't know if it continues like this, or what I've been saying is what would be the healthiest thing for the market would be to come down and close this 44.21 gap. That would give all the people that are thinking that we're heading to 8,000 on the S&P because the Fed's going to go back into QE, and they'll get washed out. And those are the ones that probably have to get washed out before we get a sustained rally. And it's just really, everybody's expecting the same thing. And whenever that happens, usually the totally opposite happens. So you can see we have the 46.99. Obviously, this is going to be a, let's say, small guy buy pivot because it's the moving average. If this gets taken out, we have the last line of sand here at the 46.80. But if we go and take a look at the daily chart, hang on one second as it loads. Here we have the 46.34, which is pretty good support right here because we have 46.08, 46.34. But if they lose that, now we're coming down to that number that I said, the 200-day moving average. And seeing the test of that, like I said, if it holds, it will give a lot of, people will really be looking to buy, but the ones that are say the greedy ones that were buying the dips the whole way down, they'll be flushed out. So those are the important pivots. Obviously, if the bulls can break back above this bear flag, and really I would say above the 47.67, then we're starting to look at these levels that are getting close to the rally highs, and then also the all-time highs. So I'm kind of open-minded on this. This bounce did make sense, but now we're getting to the oversold levels as we run into major resistance. If this gets taken out, remember, I've been showing you guys this megaphone top pattern, and it may be just what's called an expanding flat. And what that means, it's not a good thing for the bears, because you can see this is the flat right here. I'm just going to move this up. So let's say right in this area here, it's flat, or you have a little bit of an up thing. But what happens is if we came down, so you can see this is it's moving down, so it's an expanding flat to the downside, and this is always used as resistance, and this line keeps going down. So again, I'm not sure how it plays out. I'm not making any predictions right now, but there's definitely people questioning where we are right now and how we got here, and that's what I thought was going to happen. So let's see what plays out tomorrow. There's a lot of bearish, say people that are starting to come back out again and saying, that basically looking at a lot of the indicators that I look on a longer term basis and saying, this market is not safe right now, and I don't believe it is. Even if we do head higher, we have a lot going on geopolitically. We have an election year, and that's there's a lot of uncertainty out there. So let's see what plays out tomorrow. Have a great night, and I'll talk to you guys in the morning.